Okay. Good evening to all of us. I believe we are all doing well by the grace of God. Welcome to the Young Investors Digest, Young Investors Digest show this evening. And my name is Julius Kofi Sachi. I'll be your host for today. Today we have an interesting topic to discuss, and I will urge everyone that will come across this video to listen to it, and I'm sure it will be a blessing to you. So today my guest on the show is one distinguished gentleman. His name is Dr. Paul Apia Kunedu. Dr. Paul Apia Kunedu is our director in charge. The director, if I say our director, I mean he's a director for training at the Young Investors Network. He's a doctor, and he's going to tell us a lot more on the topic we have entitled, "You are the CEO of your life." You are the CEO of your life. Financial freedom is your responsibility. So financial freedom is not somebody's responsibility. It is our individual responsibilities. Good evening, Dr. Paul Apia Kunedu. If you can hear me, let's hear from you.
Good evening, Julius, and thanks very much for your kind words. I am glad to meet you all this evening as we learn some useful lessons in our journey towards the land of financial freedom. I believe everyone here wants to be financially independent or financially free, and that is why we have taken time out of our busy schedules to join this all-important meeting. You are the CEO of your life. Financial freedom is your responsibility. To kickstart, I think it's very important for us to appreciate the role of a CEO. The chief executive executive officer of any company is the overall boss. He takes the big decisions, the most important decisions to drive a company towards achieving the overall goal of a company, and that is to produce a good or service, sell on the market, make profits, and return something to shareholders at the end of the day. So if you are the CEO of your life, what we simply mean is that you are in charge of your life. You are the boss of your life. If we take your life as a ship, you are the captain of the ship. You are driving or guiding the ship to its destination. And here, our destination is to the land of financial freedom, to the point where you may decide not to work 8 to 5 every day, but based on decisions you have taken in the past, based on how you have managed yourself in the past, your financial resources should be able to take care of you when you have gotten to the land of financial independence or financial freedom. You are the commander-in-chief of your life. And so if the president of the country is the commander-in-chief of the country, you're also the commander-in-chief of your life. And so you direct and guide all aspects of your life towards achieving your life goals. And financial freedom is one key life goal that we all aspire to. Even the Bible says money answers everything. That can be found in Ecclesiastes. And so it's very important that as young people that are starting life, we aim at becoming financially free. To be able to become financially independent, I think it is very important that we learn from the most effective CEOs we have in our corporate world. And one of the key things that CEOs do is to set clear and time-specific goals for themselves at the beginning of the accounting year for the company. And so for most companies, before the year starts, there is usually a corporate retreat. Companies take 2 or 3 days to go and brainstorm, to think through the coming or ensuing year, and to adapt clear-cut goals and strategies that will help them to get to the goal. And so as a CEO of your life, it is very important that you set clear and time-specific financial goals for yourself. And I think this should start even before the time you start working. So right from the time you are in school, it is important that you set clear financial goals for the next 5 years, for the next 10 years, for the next 20 years, and the time before you get to retirement. You should have clear-cut financial goals and assets that you want to build to be a foundation, to be a base, which will generate resources. And when I talk of assets, we are looking at things that are able to generate returns, things that are able to enhance your cash flow, not things that rather take from you. And so for most young people, when we start life, we are aiming at buying a private car. That is the first thing most of us think about. We are aiming at renting a 3-bedroom self-contained for our convenience. These are some leakages. These are liabilities. If you want to start life that way, those things will take cash from you. So here, when I talk about clear-cut goals or setting to build an asset base, we are looking at assets that will generate enough returns. So we may, for instance, invest in a taxi, which will generate sales for you on a daily basis. You may want to go into building for rent, which will generate rent for you on a daily basis. These are assets. You may want to invest on the financial market, buying T-bills, buying mutual funds, buying bonds. These things will generate returns for you. And so these are asset-based. So one, set clear and time-specific financial goals for yourself. Very important. 2, spend prudently. And being able to get your goals right will guide you in your spending. Because if you have your clear-cut financial goals, every year you know how much you want to save and invest. And so you can break that down into monthly targets. And when you have such targets, it will help you to pay yourself first. Paying yourself first means that for any money that comes to you, you set aside something that you save and invest into your future before you start spending. Because all the money you spend goes to other people, right? You buy a good or service, the money goes to other people. So you go to a cocoa seller to buy cocoa, the money goes to the cocoa seller. But when you save, that money is kept somewhere and it will generate returns for you. So by paying yourself first, save first before you start spending for any money that comes to you. Have a budget. And in your budget, identify your priorities. In your scale of preference, rate your wants or things that you buy in order of priority and try to cancel out those that are less important, those that are not too critical to your needs, so that you can spend on the most important things. And your savings should always be the most important item on your scale of preference. Spend prudently. 3, seek to diversify your income sources. For most of us, our challenge has to do with our spending, but others are not just able to bring in enough because they do not seek to diversify your income. As a young person starting life, it is important that you build yourself, build your capacity, think outside the box, look out for ways through which you can diversify your income. So if you have a regular job, 8 to 5, how can you bring in additional revenues? For instance, when I was teaching at a private university, it got to a point I realized that my income was not enough. And so I decided to drive Uber to bring in additional income. It is very important that you bring in additional income. When I was doing my PhD in Italy, it got to a point I was going to load container as a way of bringing in additional income. Even though my stipends were enough for my living and even for savings, by going to load containers, I was able to generate 100 euro a day. And 100 euro, when you bring it to Ghana, that is over 1,000 Ghana cedis now. That was an additional income, which was invested, and that is supporting me now at this point, even when I don't have a regular job. Next, learn the money language. For most of us, we are literate. We are knowledgeable in our various areas of study. You can talk about economics, biology, nursing, in the various fields of study, but we refuse to build our financial literacy skills. Refuse to learn the money language. Money has a language, And for you to be able to handle money well, you need to learn the money language. For instance, there's a time value of money. The value of 1 Ghana cedi today is not the same as the value of 1 Ghana cedi tomorrow. And because we do not have this knowledge, most of us take financial decisions that hurt us in the future. When we started this year, a bag of cement was Ghana cedis. As we speak, a bag of cement is more than 70 Ghana cedis. And so if you had 50 Ghana cedis to buy cement and you wasted that money on core credit, on taking Uber, on things that are less important to your life, by the close of this year, in December, if you want to buy the same cement, you may have to struggle more to buy cement, which you probably could have conveniently bought in January. When I wanted to buy land in 2014, at the time, land was, in my area, land was 7,000. If I had wasted that money, let's say to buy a private car, which would have been a liability, a leakage, which would have siphoned money from me through repair costs, fuel, and other things. Now land at the same place is 45,000. So if I didn't buy the land in 2014, I would have had to struggle more. Maybe I wouldn't have been able to even buy land to start building. And so knowing the fact that money has a time value, the value of money today is not the same as the value of money tomorrow, will help you to be able to take the critical decisions that will help you to be financially independent. Next, make your money work for you. The average person is looking for a regular job, 8 to 5, to pay the bills. And so we run in circles. We are in a cycle. You take your money, you pay the bills, the month ends, you go to work 8 to 5, you take your money, you pay the bills, and the cycle continues. You never get outside the web of that entanglement. The rich rather make their money work for them. And so the rich buy stocks, the rich buy bonds, the rich invest in real estate, the rich invest in the transport sector, the rich invest in farms and the food chain, the rich invest in services. But the average person is always looking for a regular job. And the fact is that aside the high time, the big time CEOs, it is very difficult for you to work in a regular job and be financially independent. For you to be able to be financially independent and to get to the land of financial freedom as quickly as possible, it is important to learn how to make your money work for you. And so when you save, you shouldn't end there. Seek to invest, real investments or financial investments. You can start, when you are starting life, you can start with the simplest forms of financial investments. You can buy mutual funds, you can buy T-bills, you can buy fixed deposits with banks. As you begin to grow, you may begin to go into stocks or shares of companies. When you have built a certain base, you can begin to go into landed properties, lands and buildings. Go into the real estate sector. You may want to go into the transport sector. Make your money work for you. So that at a certain point in time, you can decide to take a break out of a regular job and be able to maintain your standard of living because your money will be working for you. Because monies you have saved and invested in the past will be enough to generate returns that can take care of you and your loved ones. Julius, at this point, if you can share the slide I shared with you for us to see, I'll be glad. Can you hear me?
Yes, I can hear you. Still trying to get that done.
Okay.
So whilst at it, I want to ask some question on what you have just said. I'm hoping that the host would share the screen so that he can, or he makes me a co-host so that I can be able to add it to show my screen. So you made mention of a number of things. The fact that we should make our monies work for us in this economy at the moment, which we are actually having some challenges with the amount we even save, even in the bank or with the investment institution. it's like nowhere is safe for our money. So what kind of investment advice are we supposed to heed to if even our financial institutions are not able to help us?
Yeah. So this connects to the point I made that it's important to learn the money language. Now, learning the money language also means learning about the financial architecture of the country, the different forms of financial institutions, the roles they play, and the different forms of financial instruments that you can invest in. Clearly, if you look at the sovereign debt instruments, which have been a ready source of investment for the average people, we are beginning to have issues with T-bills, for instance, with government debts crossing the threshold of 100% debt to GDP ratio. Clearly, government is beginning to have challenges to meet its debt obligations. And so people are beginning to think of different ways through which they can handle their assets. I think there are some experienced fund managers who are on daily basis trying to find a way around the current challenges. And the last time I spoke to the wealth manager at IC Securities, for instance, they are preempting the happenings in the financial market, and they are beginning to take positions to minimize their risk exposure. And so for the average young person here who is looking out for ways through which you can also minimize your risk, I think you can begin to identify some of such companies that are beginning to take positions to minimize their risk. For instance, a friend last week wanted to withdraw money from one of the banks, and it happened that they could not meet the withdrawal because they are highly exposed to government debt instruments, T-bills in particular. Most of the banks are now adapting the lazy way approach to investing. They just buy T-bills. They do not give loans to the private sector. And so with the impending debt restructuring, there's a kind of panic because once government is not able to redeem its debt obligations, most of the banks that have high exposure, some of them up to 40%, will clearly have issues in terms of meeting withdrawals. And so it is important that for the average person here, we learn about the level of exposure of the banks. We have 23 banks in Ghana and all the rural banks. For any bank that you want to buy an investment with at this point, it's important to know their level of exposure in government debt instruments because their level of exposure will go along with to affect their ability to redeem withdrawals going forward.
That's interesting to know. So their level of exposure is actually to the government's securities or the government's bonds is actually going to affect people. Now, a couple of weeks ago, the NHTC, which is an investment firm by government, run by government, people were struggling to get access to their funds. Is it because of this? And if it is so, what strategies can you share to help us plan our finances as students so that we don't find ourselves in some of these things?
Sure. So like I said, for banks and financial institutions that have adapted the lazy man's approach to investing, what they do is to just mobilize monies from people, just buy government securities. They sleep. At the end of the day, they take the returns, pay the interest they promise, which is usually lower than the T rate, and then they keep the difference as profits and administrative costs. And so for at this point, if you want to buy any financial instrument, it is important that you do due diligence. If you do not have the level of knowledge that will help you to do the critical analysis, to take that critical decision, you can consult investment analysts, you can consult brokers to help guide you to know what instruments to buy. If you don't want to go into financial instruments, I think at this point of high inflation, real asset is something that also returns a lot of significant profit. For instance, about 3 months ago, I was contemplating buying beans to keep and sell later. At that point, a bag of beans was 700 Ghana cedis at Ejura and Amantin and those places where beans is produced in high quantities. Because of space and other things, I didn't buy. As I speak to you now, a bag of beans in Accra goes for 1,100. So imagine as a young person, if you had bought bags of beans and kept in, let's say, May, in June, in July, per bag, you'll be returning profit in excess of 400 Ghana cedis. You realize that prices are rising almost every day. So if you buy something that can easily be sold, that can easily be resold, you can make a significant return by keeping real assets at this point in time. And so we need to be smart. We need to look out for things that are easily bought on the market, which we can also buy and keep for some time and sell to be able to keep the value of our savings and also to return some profit.
Thank you very much, Dr. Paul, Dr. Apia Kunedu. Let me pass a short advert that we can continue. So the Save a CD a Day challenge is on. 90 days challenge is on. Started in October. This month we started on 3rd October. If you haven't started yet, or if you've not even heard about it, it's not too late. You can join the Save a CD a Day challenge. Someone may ask, what is Save a CD a Day challenge? So this 90-day challenge is being promoted by the Young Investors Network and being backed by the IC Securities. It's an investment opportunity for you to save as low as 1 CD every day. So what we are seeking to do with this is to build consistency with savings. If you listen to Dr. earlier, Dr. Apia Kunedu earlier, you realize that he mentioned about letting your money work for you, mentioning a number of principles that if you really want to be financially independent, you should abide by them. So as a group or as a network that promotes financial independence, financial literacy, we are promoting Save a CD a Day challenge for the next 90 days. That is from October to December. We are seeking asking every young person to commit to saving some amount of money and let that money also grow for you. As you are doing that, you are building your investments acumen, you are building your investments attitude and character, so that when you have, if you have little, now you are able to save. If you get bigger amounts, you will still be able to save. That is by way of adverts, a short advert from a Save a CD a Day challenge. Now, Doctor, I know I was supposed to project your project
Yeah,
that
the 7 steps
image for
towards
you.
financial independence.
Yes, I'm not able to do so at the moment because the host is. I'm not able to co-host at the moment. So
okay.
So what we do is that you can go ahead with it as you have it, so that we can learn it whilst you tell us, and then we see how we can share that image with everybody.
Okay. Some few minutes. Let me.
So you take
get
us
it
through
done
the
here.
7 levels of financial freedom. So
7 levels of financial freedom. Yeah.
Yes, 7 levels of financial freedom.
Okay. Okay.
So whilst you are putting yourself together, so whilst you are putting yourself together, there's a question for you from one of the audience.
Okay.
So you can respond to it quickly, then we can move on. So he says, this is from Prince Asamoah. So he says that Ghana Stock Exchange and the Ghana Alternative Markets, what is their health with respect to the economic hits on the government securities? What is their health?
Also, personally.
Yeah.
That is the
Can
question.
you hear me?
Emerald, please mute. Kindly mute. Emerald, kindly mute.
Oh, I'm sorry.
All right, thank you very much. Please, did you hear the
Can you hear
question?
me? Yes, I
Yes.
heard you.
Okay, please
The
go on.
health of the stock market and the Ghana market.
Yes.
Yeah. With the downturn in the financial sector in general, especially the restructuring happens, the stock market will indirectly be affected. Even though I think stocks probably will be much more safer than debt instruments at this point. And that is why mutual funds or fund managers that invest a significant proportion of their income or fund in debt in stocks are probably able to sail through the storm better than those who are highly exposed in the debt instruments, particularly the sovereign debt instruments. But in terms of how the stock market will be affected, there is a general instability in the macroeconomic architecture of the country. Prices are galloping. So the cost of production of most of the companies listed on the stock markets are rising. With rising cost of production, if they are not able to raise prices to a level that will compensate for the increasing cost of production, what it means is that the profit levels of these companies will come down. And as their profit levels come down, their ability to return dividends to shareholders will be minimal. So dividends will reduce. And as dividends reduce, people buy stocks based on the assumption that companies will make profit and return something positive. And so companies that usually generate a lot of profits are able to do well because the demand for their shares increases. For instance, MTN has been doing quite well in terms of profits. So if you check the stock market in return times, MTN shares are doing very well in terms of capital appreciation because a lot of people are buying MTN shares thinking that MTN is going to generate significant profits. And that is how MTN shareholders are experiencing a significant appreciation in share prices. With the current situation, and most of the companies also borrow, aside the fact that they have raised money through shares, they also have debt. Sometimes they also take loans from the banks to invest. So as the interest rate levels in the economy is going up, what it means is that the cost of financial credit to these companies will go up, which will also eat into their profits. So generally, the performance of companies listed on the stock market may be affected because of the macroeconomic instability, because of the high and rising price level. It may eat into their profits, and as their profit levels fall, the demand for their shares may go down because the ability to return dividends to their shareholders will go down, which will affect demand for their shares. And if demand for the shares go down, all things being equal, with the same level of supply, the price level of the various companies listed may come down, which may lead to a general price depreciation on the stock market. So it is likely to affect the general index on the stock market.
Okay, it is likely to affect the general index of the stock market. So I've shared the video with the picture with everyone on the call in the chat. Yeah, so please everyone can just click and open it whilst we move along with Doc as it shares lights on the 7 levels of financial freedom. So Doc,
okay, thank you very much. Thank you, Julius. So from our title, we said you are the CEO of your life. Financial freedom is your responsibility. So as a CEO, we have made a point that you are responsible for your life. You have to organize your soft skills, your hard skills, your knowledge base, your financial resources, and all that is available to you to be able to achieve your life goals. And financial freedom is one of the critical life goals that you have as a young person. The 7 levels of financial freedom is a model that tries to give a clear picture of the stages that an average young person or anybody at all who wants to be financial freedom has to go through to be able to make your journey to financial independence stress-free. The first stage is what we call clarity. At this stage, you figure out where you are financially and where you want to go. And so from the points that I gave you, I made a point that it is important to set clear and time-specific financial goals for yourself. Now, that point of setting goals relates directly to the first stage of your journey to financial freedom. Figure out where you are financially and where you want to go. So you have to know your current financial situation. How much are you able to bring in? What is your asset base? Aside your earnings on the labor market, do you have any other assets that are generating cash flows for you? You need to figure out where you are and where you want to go. So if there's a big gap between where you are and where you want to get to, then you have to double up. We do not all have the same background. Some of us start life with our parents buying houses for us. For some of us, our parents finance our wedding. Our parents finance our masters, our PhD education. For some of us, our parents even buy insurance products and even stocks for us. For some of us, our parents started investing right from day one when we were born. But for others, our parents even borrowed to take care of us through school. And so for us, we have a bigger gap looking at where we are and where we want to get to. So it's important that we take very drastic measures. For instance, I came from the village, right? I came to stay with my uncle in Accra. Even though my uncle supported me, I couldn't have stayed with my uncle for that long. So I knew that right from the go, I need to build a base in Accra. I need to get a house to fall out of the rent trap, having to pay in excess of 1,000 Ghana cedis. Some are paying 500, depending on where you are staying. That's a lot of money. And so for me, the most important thing for me was to get a house to fall out of the rent trap in Accra. So I knew where I was. I didn't have a significant foundation in Accra, and I needed to take drastic steps to sacrifice a lot to be able to get to where I want to get to. So be clear about your financial goals and where you want to get to. 2, the stage of self-sufficiency. At this stage, you have moved out of mom and dad's house and can cover your expenses. So let's say the period after national service, when you have begun working, you are earning some significant amount of money, which is able to take care of you and which is able to make you independent, to wean you off from your parents' support. At this point, most of us are quick to even move out of our parents' house, even those that have some convenience in their parents' house, because we want to be independent, because we want to start bringing the boys and girls home for the night sleepovers. We are quick to move out. If the situation is such that you can stay with mom and dad even through this period, when you have begun working, you are earning some money, I would advise you to still stay with mom and dad, especially to the point when you are not married. Stay with mom and dad. At that point, increase your savings. At that point, increase your investments. At that point, do not fall to the temptation to buy private cars, to buy liabilities, which to us, we think of as assets. Some of us are quick to buy private cars. Some of us, especially those in banks, because it's a loan. Oh, this is a loan, a soft loan. So you take a loan, you buy a private car. The car starts being a leakage from your income because you have to pay for fuel, because you have to pay for maintenance, because using a car comes with a lot of responsibilities. And usually you move to places where normally you wouldn't go when you don't have a car. You want to move out with friends and all that. If you decide to avoid those things, if you decide to not rent and still stay with your parents, or even when you want to rent modest accommodations that you do not commit so much so that you can save and invest at this point of self-sufficiency, that will make it easier for you to get to the next steps. Stage 3, briefing room. Here you are saving some money and no longer living paycheck to paycheck. So at the stage of briefing room, you have been able to save and invested, bought some financial securities. You have probably been able to buy land. You have probably started building something. At this stage, your income is much more than your average expenditure for the month. And so you have a breathing space. At this point, when you get any additional income, I will advise that increase your savings and investments and what you give to charity, your giftings, instead of increasing your spending. For some of us, whenever we have a windfall, the first thing we talk about is spending instead of saving. When you have an additional windfall during your stage of briefing room, it is important that you increase your savings and investments, increase how much you give to charity, how much you give to support vulnerable populations, such that you are able to, for those of us who are religious or who believe in giving, that will also, in a way, open more doors for you, open your fountain of blessings, and increase your asset base in one way or the other. The next stage, stage 4, the stage of stability. At that stage, you have probably finished your building, and so you have win yourself out of the 2-year rent payments. You have your house. At that point, you can manage a small car, which doesn't take so much from your income flow. At that point, your investments are beginning to generate returns. At that point, you have diversified your income. And so you are stable. You are not financially shaky. Financially, you have stamina, like the footballer who have trained for so long before hitting the park. And so emergencies do not destabilize you. If something happens and you have to commit much more than your average expenditure, it doesn't affect you so much because you have built the shock absorbers, because you have diversified your income, you have income flows from different sources. So from the stage of stability, you move to the stage of flexibility. Here you have set at least 2 years of expenses saved. You could take a year of work. When you get to the stage of flexibility, here you do not need to depend on a regular job. So you work maybe to build more skills. For some of us, we enjoy the work we do. So at that stage, you don't work because you have to work. You work because you enjoy the work you are doing. So for instance, I will choose to teach at that stage because I enjoy teaching. Because teaching is something I will do even when I'm not paid. At the stage of flexibility, you choose to work as a passion. You choose to work because you really want to work, because you enjoy working. Not the kind of work where you wake up in the morning when you are going, you are grumbling, you are not happy, the work is stressing you up, but you still have to go because you have to pay the bills. No. When you get to the stage of flexibility, you have saved and you have at least 2 years of savings that can take care of your needs. If you decide not to work for 2 years, your income flows, returns from your investment can take care of you for 2 years. And that is a stage where you can decide to take a year of vacation. For those of us Christians, you can take a year of doing evangelism, the work of God, win souls for Christ, and your investments will still be working for you. And then the next stage is the land of financial independence. Here you can live off the income from your investments without even having to work for a lifetime. And it is possible to get to this stage by age 40, for some of us by age 35, for those that start off on a higher height, for those that have parents who build a significant start-off package for us. It is possible that by even age 35, you become financially independent. For some of us that started off from ground one, maybe 40, 45, latest by age 50, it should be possible for you to get to the land of financial independence. And then the last stage is abundant wealth. Here, money isn't a concern at all. You have more than you will ever need. You get to the stage of the Kwame Despies, the Tobinkos, the Oforisapons, and people like that. They have diversified their investments such that sometimes they even lose count of the number of companies they have. They lose count of the number of companies they have invested in. They lose count of their cars in the transport sector. They lose count of their buildings in Accra. It is possible for you to aim at that stage where you have abundant wealth, not made through corruption, but all made through fair means and made through hard work and the blessings of God. It is possible. And for us, Christians, or those of us who are religious, at this point, you begin to give more to charity, you begin to give more to support society, you begin to give more to support your church and religious organizations, you begin to give more to support your family and vulnerable people, and the good Lord will continue to bless you and bless your generations. Thank you, thank you, thank you for your attention.
All right. Thank you very much, Doc. This is very important nuggets for us, and I believe that it will really help. But I want to ask a question on the first point that you made, seeking clarity.
Okay.
That is, you have to figure out where you are financially and where you want to go. Some people sometimes want to do it, but don't know how. Is there any instrument or is there any approach we can adapt so that we can be able to find our financial state? Is there any scale? Is there something we can measure with? Is there some tool that can help us so that we can appreciate it and use it as well?
I think it is important that you write your goals down. Usually in strategic meetings, in corporate strategic meetings, we write clearly what we want to achieve for the company in the year. We have it, and we have corporate strategic documents where we have the goals spelled out and the strategies to achieve the goals. But at the individual level, even in America, research has shown that only about 3% of Americans have their goals clearly spelled out on paper. Most people just have something hanging around in their mind. At the beginning of the year, they make New Year resolutions in their mind. They seem so committed at the first night. Spiritual goals, financial, whatever, life development. But by the end of January, everything has vanished because they did not put those goals down. So it's very important that for you to be very clear, you put those notes in a notebook closer to you. You can even look at every day. So at the end of this year, I want to build my savings to 20,000 Ghana cedis. How can I get to that point with my average monthly earning of 2,000 Ghana cedis? So if you're able to write it down and do the calculations very well, then you'll be able to figure out that at your income level of 2,000 and your standard of living, it might not be possible to be able to save 20,000. And so I have to get an additional source of income. If you don't write it down and you juggle everything in your mind, it might be difficult for you to identify the loopholes and where you have to commit more, where you have to sacrifice more. And so it's important that at that stage of clarity, where you are figuring out where you are and where you want to get to, you have clear goals stated on paper. You have to be objective with yourself and know where you are and have a clear picture of where you want to get to so that you can begin to close the gaps by taking daily decisions that will help you to close the gap. So write your goals down. I think is my response to your answer.
Nuggets you have shared with us are enough to help us if we only apply them to our lives. So whoever comes up upon and whoever is on this call, I believe that our financial situation shouldn't be the same. It shouldn't go down. It should rather be going up after applying all these principles. So I want to introduce you to the Young Investors website. So we have a website that has a lot of information on some of these things. We have books. We have books that are actually spell out how you can approach some of these things that Doc has shared. So I would recommend you to Young Investors. So our website is www.yinvestors.org, yinvestors.org, www.yinvestors.org. So you can go there, you get some books. We have some books there. You can look at our activities. There are a number of things that can be helpful to you on that platform. And I want to bring to your attention again that we have ongoing a 90 days savings challenge under the Save a CD a Day challenge. So we are encouraging each and everyone to partake in that. If you are not on yet, please do. If you are on, kindly push through and let's build our savings culture. I'll take last comments, it's not last words, last comments on the topic. Doc, your final comments.
Yeah, so by way of summary, I want to emphasize on the point that you are the CEO of your own life. You are the captain of your own ship. You are the commander-in-chief of your country. That means you are the only one in that country. You have to lead yourself to success. And to be able to walk that journey towards the land of success financially, it is important that you wake up every day with a clear purpose on how you can attain that goal that you have set for yourself. And that's why it is important that you write down clearly your goals and know the important steps and sacrifices that you have to take to get to that land. For some of us that starts off without any significant support, it is important that as we begin to work and earn income, we sacrifice present consumption for future freedom. It is important that we postpone gratification. We postpone current consumption. It is important that currently we meet only our basic needs and as much as possible, try to save something significant to enable us close the gap as quickly as possible. It is important that we avoid making excuses. Excuses we can always make as to why we cannot achieve our financial goals. But if we are committed, but if we stay the course, but if we are ready to pay the price, it is possible. Believe in yourself that whatever it takes, you can also achieve anything that you set your mind to and to come to pass. Amen.
Amen. Thank you very much, Doc, for this important information that you've shared with us. You've been very generous in sharing this information with us, and we really appreciate you. We thank everyone who is on the call, Janet, Joshua, Jeremiah, Prince, Lily, Siang, Emerald, Victoria. Thank you all for joining the call, and see you same time next week on another very important topic that will be helpful for our financial life or our financial planning, financial literacy. God bless you all for joining. Thank you, and see you. Enjoy the rest of the week.
Good night.
Good night.